In the spring of 1926, two brothers in Cleveland, Ohio received identical inheritances from their father. Harold Prentice was 41 years old, a sales manager at a hardware distributor. His brother George was 38, a mechanic. Their father had left each of them exactly $3,000, a substantial sum equivalent to approximately $50,000 today. Both brothers understood they needed to do something with it. Neither brother wanted to leave it in a bank account doing nothing. They talked it over at the kitchen table for 2 evenings and arrived at different conclusions. Harold put his $3,000 into a rental property on the east side of Cleveland, a modest 2-bedroom house that he purchased for $3,000 in April 1926, rented to a factory worker and his family for $18 per month. It needed some work. He spent weekends on it. He collected rent. He built equity. The house was real. He could walk through it. He could see what his money had bought. George's $3,000 put into gold, not through a fund or certificate, actual gold coins stored at home in a fireproof box his father had left them. Gold was fixed at $20.67 per ounce by the U.S. government. His $3,000 bought him approximately 145 ounces. George's logic was simple. Gold had been money for 5,000 years. It could not burn down. It could not need a new roof. No tenant could damage it. It was real, portable, and permanent. By 1971, 45 years later, Harold's descendants had accumulated a real estate portfolio worth approximately $180,000, had collected decades of rental income, had used property equity to purchase additional properties, and had built a genuine family wealth base from that original $3,000 house. George's gold, still sitting in various family safes through the decades, was worth approximately $4,200 in 1971 when President Nixon ended the gold standard, because for 45 years the government had held the gold price at or near the same fixed level. George's $3,000 had become $4,200 over 45 years. Harold's $3,000, with rental income reinvested and properties compounding, had grown by a factor of 60. First round, real estate wins. Convincingly, decisively, not even close. But the story does not end in 1971, and this is exactly where most people's understanding of this 100-year comparison stops, and exactly where the data becomes genuinely surprising. My name is Ban, and I spend way too much time going through 100 years of asset class return data. Robert Shiller's home price data set going back to 1890, the Federal Reserve's historical gold price records, Aswath Damodaran's annual asset class return series from NYU Stern covering every year from 1928 to 2024, and the decade-by-decade breakdowns that reveal something almost no financial media discussion of this topic ever shows honestly. The winner of the gold versus real estate comparison over 100 years is not what most people think it is. And more importantly, which one wins depends entirely on when you are measuring. And the current moment in 2026 is one of the most important turning points in this 100-year comparison that has ever existed. If this challenges how you think about the two most popular hard asset investments in the world, subscribe now. Every week, we go through what the data actually shows versus what the popular narrative tells you. Let me lay out the full 100-year scorecard first. Then I will show you the decade-by-decade breakdown that changes everything. From 1928 to 2024, using Aswath Damodaran's dataset at NYU Stern, the most comprehensive and academically cited long-run asset class return series in existence, real estate returned 4.3% annually on average. Gold returned 5% annually on average. Over the full 96-year period, gold nominally won by less than 1 percentage point annually. But that headline number conceals a story of violent swings, lost decades, and decade-specific dominance that makes the full picture far more interesting and far more actionable than any simple annual average can convey. The first era of this comparison runs from 1926 to 1971. This is the era Harold and George lived through. For the entire 45-year period from 1926 to 1971, gold was effectively a non-investment for ordinary Americans. From 1933 onward, private ownership of gold was illegal under Executive Order 6102, signed by President Roosevelt on April 5, 1933. The price was fixed by the government at $20.67 per ounce, then revalued to $35 per ounce in 1934. It stayed near $35 for the next 37 years. You cannot invest in something whose price is fixed by government decree and whose ownership is illegal. Real estate dominated this era completely and without contest. U.S. median home prices rose from approximately $5,000 in 1926 to around $17,000 in 1971. Rents were collected throughout. Equity was built. Families used leverage through mortgages to amplify returns. There was simply no competition. Real estate, winner of Era 1, 1926 to 1971, by an enormous margin. Now here is where it gets genuinely startling. The second era runs from 1971 to 1980, 9 years. This is the era most people forget when they think about the real estate versus gold debate, because what happened in those 9 years is so extreme it is almost impossible to process in terms of conventional investment thinking. In August 1971, President Nixon ended dollar-gold convertibility. Gold was freed to trade at market prices for the first time in 4 decades. The pent-up inflationary pressure that had been building for years, amplified by 2 oil shocks, the 1973 Arab oil embargo and the 1979 Iranian Revolution, was released into a market that had been artificially suppressed for a generation. Gold moved from $35 per ounce in 1971 to a peak of $850 per ounce in January 1980. That is a 2,329% gain in 9 years. In that same 9-year period, U.S. median home prices rose from approximately $17,000 to approximately $47,000, a gain of approximately 176%. Both assets performed well in absolute terms against the backdrop of double-digit inflation. Gold outperformed real estate by a factor of more than 13 to 1 in percentage terms. Gold, winner of Era 2, 1971 to 1980, by a margin so large it barely seems real. But then the third era arrives, and it runs for 20 years, and real estate takes back everything gold had gained and more. From 1980 to 2000, gold entered a brutal, grinding 2-decade decline. Paul Volcker at the Federal Reserve raised interest rates to 22% in the early 1980s to crush the inflation that had driven gold to $850. As inflation fell, as real yields rose, and as the long bull market in stocks began, gold became the worst-performing major asset class in the world. Gold fell from $850 per ounce in January 1980 to $252 per ounce in August 1999, a 70% decline over 20 years. If you had bought gold at the 1980 peak and held it for 20 years, you had lost 70% of your money in nominal terms and nearly everything in inflation-adjusted terms. Real estate in that same 20-year period? U.S. median home prices rose from $47,000 in 1980 to approximately $119,000 in 2000, a 153% gain. Steady, unspectacular by comparison to the 1970s gold run, but relentlessly positive. And rental income was flowing throughout. Property owners were building equity, paying down mortgages, collecting monthly cash flow from tenants who had no equivalent in the gold market. Real estate, winner of Era 3, 1980 to 2000, 20 consecutive years of dominance. Now, the fourth era, and this is where the surprise lands hardest. From 2000 to 2011, the dot-com crash, the September 11th attacks, the Iraq War, and ultimately the 2008 financial crisis collectively shattered confidence in financial assets and triggered extraordinary monetary policy responses. The Federal Reserve cut rates aggressively and held them near zero. The government ran large fiscal deficits. Global central banks expanded their balance sheets. Gold began its second great modern bull market. From $252 per ounce in 1999, gold rose to $1,920 per ounce in September 2011, a 661% gain in 12 years. But here is the critical comparison for Era 4. Real estate did not just underperform gold in this period, it collapsed. The S&P Case-Shiller National Home Price Index shows that U.S. home prices declined approximately 27% nationally from 2006 to 2012. In the hardest-hit markets, Phoenix, Las Vegas, Miami, parts of California, declines of 40 to 60% were common. Families who had bought in 2005 or 2006 found themselves underwater on mortgages they could not service, in homes worth dramatically less than they owed. The 2008 crisis was fundamentally a real estate crisis, and the asset that was supposed to be the safe, reliable, never-goes-down alternative to volatile stocks turned out to have a specific vulnerability that gold does not share: leverage. Real estate is almost universally purchased with borrowed money. When prices fall, leverage does not reduce the loss, it amplifies it. A family that bought a $300,000 house with 20% down and 80% mortgage held $240,000 of debt against an asset that had fallen to $225,000. They were underwater. Gold held in a safe has no mortgage against it. It cannot go underwater. Gold, winner of Era 4, 2000 to 2011. Real estate did not just lose, in many cases it destroyed families financially. Era 5 runs from 2011 to 2024, and it is real estate's turn again. From its 2011 peak of $1,920 per ounce, gold fell for 4 years, reaching a low of $1,049 in December 2015, a 45% decline. It then traded sideways for years, recovering slowly. Real estate, meanwhile, entered one of the longest and most powerful appreciation cycles in American history. Low interest rates post-2008 drove demand. Limited housing supply created structural scarcity. Remote work after 2020 expanded demand geographically. The S&P Case-Shiller National Home Price Index rose from its 2012 trough to more than double by 2022. U.S. median home prices went from approximately $150,000 in 2012 to approximately $420,000 in 2024, a 180% gain in 12 years. Real estate produced capital appreciation, rental income, the leverage benefit working in the positive direction this time, and tax advantages through mortgage interest deductions and capital gains exclusions on primary residences. Real estate, winner of Era 5, 2011 to 2024, by a significant margin on a total return basis. And this is the era that has shaped most living investors' intuitions about real estate. If your investing career began after 2012, you watched real estate reliably appreciate while gold spent 4 years declining from its 2011 peak. Your lived experience of this comparison points entirely towards real estate. The data says that experience is real and that it is also the product of a specific macro era that has specific ending conditions, not a permanent truth about which asset is inherently superior. So here is the full 100-year scorecard laid out honestly. Era 1, 1926 to 1971, real estate wins. 45 years, gold was legally suppressed, no competition. Era 2, 1971 to 1980. Gold wins. 9 years. 2,329% versus 176%. Not even remotely close. Era 3, 1980 to 2000. Real estate wins. 20 years. Gold lost 70%. Real estate gained 153%. Era 4, 2000 to 2011. Gold wins. 11 years. Gold gains 661%. Real estate crashed 27% nationally. Era 5, 2011 to 2024. Real estate wins. 13 years. Gold struggled for 4 years and recovered gradually. real estate nearly tripled. Score across 5 eras, real estate wins 3, gold wins 2. But gold's 2 wins came in compressed timeframes of extraordinary, history-altering gains. Real estate's 3 wins were longer, steadier, and generated income throughout. The 100-year annualized comparison, 5% for gold versus 4.3% for real estate, reflects precisely this pattern. Gold wins its eras in explosions. Real estate wins its eras in grinding, compounding, income-generating consistency. And here is the finding that almost nobody discusses when they present this data. The real estate return figure of 4.3% annually does not include rental income. It measures home price appreciation only. The Robert Shiller Case-Shiller Index tracks prices, not total returns. When rental income is included in the calculation, real estate's total return rises significantly. The Federal Housing Finance Agency estimates U.S. home prices have appreciated at approximately 4.2 to 4.3% annually since 1991. Add an average rental yield of 5 to 7% on investment properties, and the total return on real estate as an income-producing asset dwarfs the headline appreciation figure. Gold's 5% annualized figure is a price return because gold generates no income. The comparison between a price-only real estate figure and a price-only gold figure is the only fair comparison. The moment rental income enters the calculation, real estate's long-term total return is substantially higher than gold's. But gold has one structural advantage that the annualized return figures cannot capture, and that advantage explains everything about Era 2 and Era 4 and why 2026 may be the opening of Era 6. There is also a cost comparison that almost no one runs honestly. Real estate carries property taxes averaging 1 to 2% of value annually, maintenance costs of 1 to 4% annually according to industry estimates, insurance, transaction costs of 6 to 10% on sale, and management costs if the property is rented rather than owner-occupied. A property that appreciates 4.3% annually before costs may be generating net real returns of 1 to 2% annually after all carrying costs are accounted for. Gold's carrying costs are storage, approximately 0.5 to 1% of value annually in a professional vault, or near zero at home. The cost structure of these two assets is fundamentally different in a way that the headline return comparison obscures completely. Gold performs in specific, defined macro environments: low real interest rates, weak dollar, fiscal deficit expansion, currency debasement concerns, geopolitical stress causing safe haven demand. In those environments, gold does not merely match real estate. It can return 2,300% in 9 years, while real estate returns 176%. The question that determines everything about which asset wins any given decade is not which is better in the abstract, it is which macro environment we are currently in. Real estate performs best when interest rates are falling or low, credit is freely available, wage growth supports rental demand, and population growth drives housing demand. These conditions defined 1945 to 1971, 1983 to 2006, and 2012 to 2021. Gold performs best when real interest rates are negative or falling. The dollar is weakening. Central banks are expanding their balance sheets. Fiscal deficits are widening, and institutional confidence in paper assets is declining. These conditions defined 1971 to 1980 and 2001 to 2011. Now, look at the 2026 data. U.S. federal debt is at 122% of GDP, the highest outside of World War II. Annual federal interest payments exceeded $1 trillion for the first time in history, according to U.S. Treasury fiscal data. The Federal Reserve's balance sheet expanded by over $4 trillion during the COVID period. U.S. M2 money supply grew 26% in 2021 alone, the largest single-year expansion in American history. Gold hit a new all-time high of $5,589 per ounce on January 28, 2026, having delivered 60% returns in calendar year 2025. 53 new all-time highs in a single year. central banks purchased 863 tons of gold in 2025, according to the World Gold Council, remaining historically elevated for the fourth consecutive year. At the same time, real estate is facing structural headwinds it has not faced in decades. Mortgage rates have remained elevated well above the historic lows of 2020 and 2021. Housing affordability has reached its worst reading since the early 1980s. The home price-to-income ratio is at record highs nationally, and the leverage that amplified real estate gains from 2012 to 2022 is now working against buyers who financed at peak prices. The gold-to-housing ratio, the number of ounces of gold required to purchase a median-priced U.S. home, is one of the most precise long-cycle indicators in the 100-year dataset. At the 1980 gold peak, the ratio hit approximately 2.3. You needed only 2.3 ounces of gold to buy a median U.S. home. That was Era II gold dominance at its maximum. By 2001, the ratio had swung to approximately 500 ounces. Real estate was at peak value relative to gold, and Era IV was approaching. Right now, with gold between $4,000 and $5,000 per ounce and median U.S. home prices near $429,000, the ratio has compressed significantly from its 2001 extreme. The direction of that compression identifies where we are in the 100-year cycle. For the specific instruments, SPDR Gold Shares, ticker GLD, provides direct price exposure with near-perfect correlation to spot gold. Farmland Partners, ticker FPI, gives productive land exposure without the management burden and leverage risk of direct real estate ownership, with the USDA confirming 49 years of appreciation in the last 50. The Vanguard Real Estate ETF, ticker VNQ, provides diversified real estate exposure without single property concentration risk or mortgage leverage. Let me bring this back to where we started. Harold Prentice made the right decision for 1926 and the 45 years that followed. The gold standard made gold a non-investment. Real estate compounded quietly and relentlessly through the post-war boom, the baby boom, the suburban expansion, the decades of falling rates. He built a family wealth base that grew by a factor of 60. George Prentice made the wrong decision for Era I, not because gold is bad, but because government policy made it impossible for gold to function as an investment for those 4.5 decades. Then, Era II arrived. Everything reversed. The family that had been accumulating gold quietly through the late 1960s, impractical and apparently pointless when the price barely moved, suddenly held an asset that gained 2,300% in 9 years, while their neighbors celebrated Cleveland real estate returns of 176%. Right asset, wrong era. Then right asset, right era. The difference between those two positions is the entire ballgame across 100 years of data. The data does not tell you which asset is permanently better. It tells you that the answer changes by era, that the macro environment determines which era you are in, and that the macro environment of 2026, federal debt at 122% of GDP, central banks buying gold at historic rates, real interest rates under pressure, the dollar in a long-term structural weakening trend, according to the World Gold Council's own analysis, looks considerably more like the opening of Era II or Era IV than the continuation of Era V. 100 years of data. The winner is not what most people think. The winner is whoever understood which era they were in. This is Ban. Stay sharp out there.